Silver didn't just tag $60. It kicked the door in, walked straight through, and kept going while most people were asleep. In the last 12 hours, price didn't stall at the magic round number. It pushed into the $61.85, $62.14 zone and held there long enough to light up every social feed on the planet. Now you're seeing the same phrase everywhere. Short squeeze. Some people are shouting it like a victory chant. Others are shrugging it off as meme talk. Meanwhile, buried under the noise, there's a quieter line in the data. Inventories are at record lows. So the real question isn't, did silver really squeeze the shorts overnight? The smarter question is, what does a $62 breakout on top of record low inventories actually tell us about where we are in this cycle? By the end of this video, you'll have three things. A clear picture of what really happens in a metal's short squeeze, not the movie version. A sober read on what this $62 move actually signals about the structure of the silver market. A practical way to respond without turning into a leveraged roulette player or an ostrich with its head in the sand. Let's start with what just happened. 1. What? $62 silver really means beyond the screenshot. If you just look at the chart, it's tempting to boil it down to silver was here yesterday and it's higher today. Big deal. But context matters. This isn't $62 in a fat, oversupplied market where warehouses are bursting and miners are begging for bids. This is $62 after years of structural deficits, after a move through the old $1.50 roof, with visible inventories already scraped thin, and with the short squeeze narrative going viral at the exact same time. That combination tells you a few things. The move isn't just speculative froth. It's happening in a market with very little slack. And it's forcing people who were betting against silver to rethink their risk. If you were short silver at $25 and you thought $30 was unthinkable, you've just watched price more than double against you. If you are short at $40, confident that $50, $55 was a blow-off, you now have the joy of watching price live comfortably above $60. That's not just a bad trade. That's margin clerk knocking on the door territory. And that's where short squeezes are born. But before we call this a full squeeze, we need to unpack what that actually means too. What a short squeeze really is. And most people hear short squeeze and think of movie scenes. Evil hedge fund manager, Reddit army, candles straight to the moon. Reality is messier. A short squeeze in a metal like silver isn't just price went up a lot quickly. It's a particular chain reaction. Large short positions exist from traders, hedgers, structured products. Price moves against them far enough and fast enough that margin calls start hitting and risk models start screaming. Shorts are forced to buy back to stop the bleeding. Their buy orders push price even higher. Higher prices trigger more forced covering, and the loop feeds on itself until the weakest hands are gone. In a commodity with ample inventory, a squeeze is ugly, but manageable. You can source metal. You can deliver against contracts. You can lean on physical supply to keep the paper market honest. In a commodity where inventories are already at record lows, now you're lighting a match in a dry forest. Because if those forced buy orders arrive in a market where there isn't much metal immediately available and big holders don't feel like selling, then every incremental unit of demand hits a brick wall of, sorry, we don't have it at that price. That's when price starts behaving less like a financial number and more like a crowd trying to fit through a shrinking door. That's the behavior you watch for now. Not just, is price up, but who's being forced to buy? And what are they buying against? 3. Why record low inventories turn a rally into a weapon. Let's get concrete. Think of silver's available float. The metal actively for sale as chairs in a game of musical chairs. For years, it looked like there were more chairs than players, enough seats for anyone who wanted in or out, no reason to rush. That illusion lasted as long as miners could sell comfortably into the market, vaults looked full on paper, and large holders were willing to part with metal at modest prices. Now fast forward to where we are today. Deficits year after year, visible stocks drained to levels nobody's seen before. Industrial demand that doesn't care about your trading view, and governments quietly accumulating instead of distributing. The number of chairs has shrunk, then you add a violent breakout through $60, short sellers under pressure, social media fanning flames. Suddenly, you don't just have fewer chairs. You have more people in the room, moving faster, all with the same thought. If this thing really runs, I don't want to be the only one without a seat. That's why inventory matters more than the daily candle. A $2 move in a deep, oversupplied market is one thing. A $2 move in a thin, starved market can be the first crack in the dam. You don't know if this is the crack that breaks it, but you can see the pressure building. 4. This isn't 1,980, but it rhymes. Anytime silver goes vertical, someone will bring up the Hunt brothers and 1,980. See? It spiked. Then it crashed. Don't worry about it. That's a lazy lesson. The useful takeaway from 1,980 isn't silver always crashes. It's this: leverage kills. Rule changes crush people who depend on paper. The physical metal itself doesn't vanish when the party ends. Back then, two brothers tried to corner a market using futures, borrowed money, aggressive delivery demands. The system hit the panic button, changed the rules, and the brothers were vaporized. But people who bought unleveraged physical earlier and didn't sell into the hysteria, they ended up owning metal at a much higher base price than the old norm. Now compare that to today. It's not two Texans, it's global participation. It's not a single exchange panic, it's multiple hubs showing stress. It's not a world where silver is a sideshow. It's built into solar, EVs, tech, defense. The rhyme is, paper games on top of tight physical supply eventually run into reality. The difference is, this time, silver isn't just an inflation hedge. For a few wealthy speculators, it's wiring the energy transition, the electronics in your pocket, and parts of the digital and military infrastructure that governments consider non-negotiable. In that context, a move through $60 into the low dollar 60 seconds isn't just nostalgia. It's the market quietly saying, the old range is dead. We are repricing an industrial and monetary foundation piece for a much harsher world. 5. What this move does not mean. Let's clear out some emotional noise. First, a push to $62 does not guarantee that silver goes in a straight line to $80, $100, or $200. Markets breathe. Even the nastiest short squeezes overshoot, shake people out, retrace violently, then either consolidate at a higher plateau or round trip back into the old range. If you anchor your entire psychology to, if it's not at $X by date Y, the thesis is dead. You're setting yourself up to make dumb decisions on normal volatility. Second, a rally does not erase risk. If you chase with maximum leverage, no plan, no risk control, the market doesn't care that you believe in silver. You're just new fuel for whatever move comes next. Third, a breakout does not mean it's too late for anyone who wasn't all in at $20. This isn't a meme stock that can be delisted overnight. It's a metal that's mined slowly, consumed relentlessly, repriced in each new regime. If anything, a violent move through a historic level is the market tapping you on the shoulder saying, hey, this is real. Stop treating it like a toy. You still have time to think clearly if you don't let social media set your time horizon. 6, how to respond without losing your head. Now, the part that actually affects your life. What do you do when silver smashes through $62 and everyone's screaming, short squeeze? Here's a calmer framework. A, choose your time frame. Are you a day trader trying to scalp moves? A swing trader trying to ride this wave? A builder trying to protect and grow long-term wealth? Each of those roles has different rules. The trouble starts when long-term builders behave like day traders, or short-term gamblers tell themselves they're investors. If your real goal is, I want some of my wealth in a metal that governments, grids, and industry can't live without, then your decisions should reflect that. Smaller position sizes, no leverage, a willingness to sit through volatility, a plan that doesn't depend on predicting next week's candle. B, set an allocation, not a fantasy exit. Instead of saying, I'll go all in now and sell everything at $100, ask, what portion of my savings makes sense in silver at all? Maybe that's 5%, maybe 10, 15%, maybe a mix of gold and silver. The number isn't magical. What matters is you pick it deliberately. You don't chase every spike. You don't abandon the plan on every correction. In a world where silver has just told you that the old ceiling is gone, the smarter move is, let me build to a steady allocation so I'm not scrambling later. C, separate your fun trades from your foundation. It's okay to trade. Take a small sleeve of your capital and play squeezes. Trade miners, try options. If you understand the risks, but keep that separate from the part of your wealth that's supposed to survive policy mistakes and market breaks. That foundation should look more like physical coins and bars you can ultimately take delivery of, or at least structures where you clearly understand custody and risk, paid for with cash, not borrowed money. When volatility gets insane, your fund sleeve might blow up or double. Your foundation is what lets you sleep either way. 7. So, is this the short squeeze? Everyone wants a yes, no answer. Is this the squeeze? Is this the big one? Here's the honest version. The price behavior. Smashing a historic zone and holding above it is what you expect in the early phases of a squeeze. The inventory situation, record low stocks, tightness in major hubs, is exactly the kindling you'd want if you were designing a structural move. The narrative, shorts trapped, supply gone, we're just getting started, is what you always hear during a move, never at the boring bottom. But the market doesn't come with labels. There's no bell that rings and says, congratulations, this is the ultimate squeeze. Please fasten your seatbelts and proceed directly to $100. What you do have is a metal breaking into a new price regime in a world of tight inventories and rising structural demand, with a growing crowd finally noticing the supply problem you've been watching for months or years. You don't need certainty to act wisely. You just need to stop pretending that nothing important has changed.